All right, future CFA rockstars, today we're diving into financial statement modeling, which is the bread and butter of valuing companies and their securities. If you want to be a top-notch analyst, you need to know how to forecast a company's future financial performance and use it to figure out its value. The general game plan here is simple. Start with the revenue and then build out the rest of the financial statements like a well-oiled machine. Now, don't just take numbers at face value. Keep an eye out for any behavioral biases that could skew your model. You've got to blend both microeconomic and macroeconomic factors into your forecast. Things like competition, inflation, and even technological changes. Let's get into the nitty-gritty. First things first, let's talk about building that model. It all starts with an industry overview. You have to understand the industry structure. The key here is to analyze the 5 competitive forces: the threat of substitutes, rivalry among competitors, bargaining power of suppliers and buyers, and the threat of new entrants. For example, if consumers are loyal to a brand, the threat of substitutes is low. If the market has high barriers to entry, new competitors won't be barging in. All these factors play a crucial role in your model. Next, we move to the company overview. Here, you break down the different business segments and their contribution to the total revenue and operating profit. If you're dealing with a company with multiple segments, you'll need to project sales for each one and then combine them to estimate total sales. This is a bottom-up approach that lets you be granular in your forecasts. All right, let's talk pro forma income statements, the backbone of financial forecasting. The key here is to project revenue first. Think of it like the foundation of a house. You can't build anything without it. You use a hybrid approach. Start with a top-down analysis like economic growth projections in relevant regions. Then dive into a bottom-up analysis like segment-specific growth trends. For instance, revenue might change due to fluctuations in volume or pricing strategies. Organic growth is what you want to focus on. It reflects real sustainable growth without one-off effects. Next up is the cost of goods sold, COGS. If there's a high demand but limited supply, the COGS could decline, improving the gross margin in future periods. It's all about supply and demand, folks. And don't forget selling, general, and administrative SG&A expenses. These tend to increase when companies expand distribution networks or up their advertising game. So if a company is going all out with new ads or expanding into new markets, expect those SG&A expenses to rise. Operating profit, or EBIT, earnings before interest and taxes, is a key number. It's essentially revenue minus COGS and SG&A plus any other income from operations. EBIT should match the cumulative EBIT of all business segments combined, giving you a consolidated view of profitability. Don't forget about EBITDA, which is EBIT plus depreciation and amortization. This metric is crucial because it gives you a cleaner look at operational efficiency by stripping out non-cash expenses. When it comes to non-operating items like finance expenses, income taxes, and shares outstanding, these can throw a wrench in your model if you don't forecast them accurately. For finance costs, you need a good handle on debt levels, cash positions, and interest rates. Let's shift gears to the cash flow statement and balance sheet. When forecasting cash flows, always start with net income and adjust for non-cash items like depreciation. Keep an eye on working capital changes. An increase in working capital means cash outflows, which can crimp cash flow from operations. For the balance sheet, it's a balancing act, pun intended. You've got to forecast capital investments, assess depreciation rates, and keep track of working capital. A growing company with rising sales will likely have an increasing balance sheet with higher capital expenditures and inventory levels. Now, how do we put a value on the company? Several metrics come into play: free cash flow, earnings per share, EBITDA, or EBIT. The ultimate goal is to derive a discounted cash flow DCF value. For that, you need normalized operating profit, less taxes, add back depreciation, adjust for changes in working capital, and subtract capital expenditures. Voila, free cash flow to the firm, FCFF. All right, team, this is where things get interesting. Financial modeling isn't just about plugging numbers into a spreadsheet. Nope, it's also about navigating the psychological minefield of biases that can lead you astray. We're all human, right? And humans have these pesky little things called biases that can cloud our judgment. So let's unpack the 5 big ones that tend to trip up analysts and look at how you can avoid falling into these traps. So imagine you're at a party and someone asks if you're good at predicting the stock market. If you puff out your chest and say, "I'm a rock star at it," you might be showing a bit of overconfidence bias. This bias is when people think they know more than they actually do or believe they're better at forecasting than they really are. It's like believing you can call the next winning stock based on a gut feeling. Think of the tech bubble in the late 90s. Analysts were overconfident, predicting endless growth for dot-com companies. The result? A crash that wiped out trillions of dollars in market value. That's what happens when overconfidence takes over and reality doesn't check in. How to counter overconfidence. Keep yourself grounded. Record all your forecasts and then go back and see how often you were right versus how often you were dead wrong. It's like a reality check. Also, use scenario analysis. Create multiple possible outcomes, best case, worst case, most likely case, to avoid getting stuck in one overconfident narrative. Illusion of control. This one is a cousin of overconfidence. It's when you believe you have more control over outcomes than you actually do. Think about it. Ever feel like you've got a handle on things just because you gathered tons of data? That's the illusion of control at work. You're mistaking a lot of information for actual insight. A fund manager might think they can outsmart the market because they have access to the latest research reports, advanced algorithms, and expert opinions. But guess what? The market is full of uncertainty, and no one has a crystal ball. Now, how to counter illusion of control? Keep it simple. Focus on key drivers and not every piece of data under the sun. Simplicity is your friend, and remember, don't confuse information gathering with actual predictive power. Conservatism bias. Now this one is sneaky. It's when people are slow to update their beliefs or forecasts even when new information clearly suggests they should. Imagine you're driving on a highway and your GPS says to take the next exit, but you keep going straight because that's the route you always take. That's conservatism bias in action, refusing to change despite new directions. Let's say you're analyzing a retail company and you see new data showing a big shift towards e-commerce. But you stick to your old forecast that assumes steady foot traffic in brick and mortar stores. You're stuck in the past, buddy, and you're missing the boat. To counter conservatism bias, you should actively seek out new data and challenge your assumptions. Make it a habit to ask, does this new info change anything? Don't be afraid to pivot if the situation calls for it. Representativeness bias. This bias is like playing the game of stereotypes. You see a piece of new information and immediately classify it based on past experiences or patterns you've seen before. Ever hear the phrase, if it looks like a duck and quacks like a duck, it must be a duck? Well, in finance, it might be a goose in disguise. Suppose you're analyzing a tech stock and it's showing rapid growth, just like some of the big tech names did a decade ago. You might assume it's the next Apple or Amazon. But hold on, the market environment, competitive landscape, and business model might be completely different. Just because it looks like the next big thing doesn't mean it is. To counter representativeness bias, always dig deeper. Check for differences in context, market conditions, and unique factors that set this new data apart. Base your analysis on solid evidence, not just patterns that seem familiar. Confirmation bias. This one's a classic. It's when you only seek out information that confirms what you already believe and ignore anything that contradicts it. It's like being in an echo chamber where you only hear what you want to hear. Dangerous, right? Picture an analyst who is bullish on a stock. They keep reading only the news articles and analyst reports that praise the company, ignoring the red flags about declining market share or regulatory issues. They're setting themselves up for a nasty surprise. To counter confirmation bias, make it a rule to actively look for contradictory information. Challenge your thesis. If you think a stock is a buy, find reasons why it might be a sell. Talk to people who don't agree with you. The goal isn't to prove yourself right, but to test your hypothesis rigorously. Now, let's switch gears and talk about how competition affects prices and costs. We've all heard of Michael Porter's 5 forces, right? It's like the Bible of competitive analysis. But how do you use it in financial modeling? Here's the deal: threat of substitutes. When there are plenty of alternatives, customers will switch if the price is too high. For instance, if you're analyzing a beverage company, remember there are tons of substitutes: juices, teas, energy drinks. Price hikes, not so easy. Intensity of rivalry. Think of the smartphone market. Apple versus Samsung versus Google versus the world. When the rivalry is intense, nobody can push prices up without losing market share. This needs to be reflected in your projections. Bargaining power of suppliers and buyers. In the airline industry, for example, suppliers like Boeing or Airbus have significant power because there aren't many alternatives. On the flip side, buyers, the passengers, have lots of choices. That balance affects ticket pricing and overall cost structure. Threat of new entrants, high barriers to entry, like in the pharmaceutical sector, thanks to regulation and high R&D costs, mean less price pressure. But in sectors like e-commerce, where anyone can set up shop online, prices are under constant pressure. The bottom line? When you're modeling, always consider these competitive dynamics. They'll shape everything from revenue forecasts to cost projections. So let's wrap this up. Below average revenue growth is usually on the horizon for a company if it's dealing with high fixed costs, a declining market, and a consolidated customer base that holds all the power. Throw in intense price competition and a high threat of new entrants, and you got a recipe for stagnant growth. Now, when a company's industry is fragmented with no clear price leader, limited growth, high exit barriers, and big fixed costs, their ability to adjust prices is pretty limited. Without price leadership, companies can't just hike prices to make up for falling sales volumes. It's like being stuck in a crowded room where no one can speak up. One more thing, the government isn't considered a sixth competitive force because its impact can swing both ways. The real takeaway here is that the influence of the government should be evaluated through how its policies shape the other 5 forces in the competitive landscape. Finally, let's touch on inflation and deflation, 2 sides of the same coin that can turn your model upside down. Inflation can eat away at profit margins, while deflation can lead to pricing wars. In the early 2020s, inflation spiked globally. Companies with strong brands like luxury goods makers managed to pass on higher costs to customers without losing sales. Meanwhile, generic consumer goods companies struggled because they had less pricing power. When you're forecasting, think about who has the muscle to raise prices and who doesn't. Japan has been fighting deflation for decades. Companies there often held off on lowering prices to avoid hitting profit margins, but that led to lower sales volumes. It's a tricky balance. Get your timing wrong, and it could cost you. Now, how to model inflation and deflation. Look at how companies adjust prices relative to competitors, the elasticity of demand for their products, and the geographic and currency dynamics of their sales. This will help you predict how changes in price levels will impact overall revenue and profitability. When it comes to inflation and deflation, the impact on a company's pricing strategy can vary a lot depending on the industry, competition, and how price-sensitive demand is. If demand is price elastic, hiking prices to cover inflation and costs can actually hurt revenue as customers shy away. But when demand is price inelastic, raising prices can boost revenue, even if input costs are climbing. Now, things get tricky in international markets. If a company's export market faces higher inflation than its home country, the export country's currency could depreciate, wiping out any gains from higher prices. When it comes to cost projections under inflation or deflation, the effects hinge on a few key factors. How companies buy their inputs, like long-term contracts or hedging to avoid price swings, the competitive environment, like the availability of alternative inputs, and how well they manage costs. As an analyst, you'd want to watch what's driving input prices, like weather for agricultural goods, see if the company can substitute cheaper materials, and gauge how efficient they are at handling cost increases. Understanding these dynamics can help predict how inflation or deflation will affect a company's bottom line. All right, folks, we're nearing the end of today's lecture, and it's time to tackle one of the trickiest parts of financial modeling, deciding on the forecast horizon and making those long-term forecasts. How far out should you predict? 3 years, 5 years, 10 years? It's not a one-size-fits-all answer, so let's break it down. The forecast horizon is basically the time period over which you make your financial projections. It depends on several factors, and each has a significant impact on how you model a company's future. Let's take a look at the 5 main considerations. Different investors have different goals. Some are in it for the long haul, think Warren Buffett style, buy and hold, while others might be more short-term, like a hedge fund manager looking for a quick turnaround. Your forecast horizon should align with the investor's strategy. A pension fund with a 30-year investment horizon might want a very long-term forecast to understand the steady-state, mid-cycle profitability of a company. In contrast, a venture capitalist looking to exit in 5 years would want a shorter forecast period to focus on early growth phases. This one's a bit more technical. If an investor has a high portfolio turnover rate, let's say 50 to 60% annually, they're likely to favor shorter forecast periods, like 1 to 2 years. For a lower turnover, like 20 to 30%, they'd be looking at 3 to 5 years. The idea here is to match the forecast horizon to how often the investor buys and sells assets in their portfolio. If you're an equity analyst working with a fund that turns over its portfolio every 3 years, a forecast horizon of 3 to 5 years would make sense. But if your client is a buy and forget type, you're talking 10 years or more. Some industries are more cyclical than others. Think about the airline or automotive industries. They go through ups and downs based on economic cycles. Your forecast horizon needs to be long enough to cover a full cycle to see both peaks and troughs. During the COVID-19 pandemic, the airline industry saw a massive downturn. An analyst making a one-year forecast in early 2020 would have predicted doom and gloom, but a 5-year forecast would show recovery post-pandemic. For cyclical industries, a longer forecast helps smooth out these ups and downs and provides a better picture of a company's normalized earnings. Company-specific factors. This is where you consider the company's own situation. Is it in the middle of a major acquisition? Did it just launch a groundbreaking product? Your forecast horizon should be long enough to capture the expected benefits or risks of these events. If a tech company is expected to benefit from a recent acquisition, you might need a 5 to 7 year horizon to see those benefits play out fully in the financials. Conversely, if a company is undergoing restructuring, you might need a shorter horizon to reassess its post-restructuring viability. Finally, let's not forget who's signing your paycheck. Some firms have their own preferences for forecast horizons based on their research methodologies or client needs. As an analyst, you've got to play by their rules. If you're working at a brokerage that caters mainly to retail investors, you might find yourself using a shorter forecast horizon because those clients are more interested in near-term gains. Once you've nailed down your forecast horizon, the next step is to estimate the terminal value. This is where you calculate the value of a company beyond your forecast horizon, assuming it grows at a stable rate forever. There are a couple of methods to do this. Historical multiples-based approach assumes that the future growth and profitability of the company will mirror its past. But if the future isn't looking like the past, maybe because of a major acquisition, new regulations, or changing market dynamics, you need to adjust your multiple. If you're evaluating a company that's about to face increased competition due to deregulation, its future profitability might be lower than in the past. In such cases, you'd apply a discount to the historical multiple to reflect this risk. Discounted cash flow, DCF approach. Here you use the terminal year's cash flow to estimate a perpetuity value. But remember, you want to use a normalized cash flow, one that represents a mid-cycle level, free of any one-time booms or busts. Imagine you're valuing an airline company. If you use the cash flow from 2020, a trough year during COVID-19, as your terminal value, you'll undervalue the company. Conversely, using cash flow from a peak year would overvalue it. The key is to find that steady state mid-cycle cash flow. Terminal value isn't set in stone. Several factors can cause it to swing up or down, especially if the company has high financial leverage. Let's look at a few. Economic disruption. A global financial crisis, like in 2008, can wipe out entire business models. If you're valuing a highly leveraged company, a slight economic downturn can mean game over for them. Government regulations and technological developments. Some industries are more vulnerable to changes in regulation and technology than others. Utility companies might worry more about regulations, while tech companies are more concerned about rapid tech changes. Consider the energy sector. If governments worldwide tighten carbon emission regulations, companies with heavy carbon footprints could see their terminal values shrink. On the other hand, a biotech company that gets regulatory approval for a blockbuster drug could see its terminal value soar. Another crucial aspect is recognizing inflection points, moments when a company's growth trajectory changes dramatically due to factors like interest rate shifts, regulatory changes, or market disruptions. Think of companies during the dot-com boom. Many experienced rapid growth inflection points only to crash when the bubble burst. If you didn't factor in the potential for a market correction, your long-term forecast would have been way off. When calculating terminal value using the perpetuity growth method, the growth rate used must be reasonable. If you're modeling beyond 5 years, don't assume the company will keep growing at 10% forever. In most cases, a long-term growth rate aligned with GDP growth or inflation is more realistic. And there you have it. Forecasting isn't just about throwing numbers around, it's about understanding the dynamics of the industry, the company's position, and broader economic forces. You've got to be part detective, part economist, and part fortune teller. Keep these points in mind, and you'll be crafting robust financial models that can withstand the test of time and the scrutiny of your bosses. So remember, always align your forecast horizon with the investor's strategy, account for industry cycles, consider the company's unique situation, and be mindful of economic realities. Get these right, and you're on your way to becoming a top-tier analyst. Until next time, keep those calculators hot and your analysis even hotter. Happy analyzing!